Hey, everybody. Welcome back to today's Market Explained, a 4-star podcast. This is our bi-monthly series where we cover the markets and what's going on in the financial world. And I'm Brian Kasal, your host. I've got Chris Reardon, my co-conspirator or co-host, as it were, on this podcast. Chris, welcome back to the podcast.
Thanks, Brian. Good afternoon to everyone, and glad to be on the podcast.
And everybody knows, those of you who don't, Chris is Director of Development for 4-star. He handles all things in portfolios, manages our investment management operation as well, and development and recruiting. And so Chris is an invaluable member of the team with great insights on the investing world. And so we're proud to have him. And I'm your CEO and founder of 4-star. And I'm an advisor to CEOs as well. Philanthropic advisor, and also insiders as well. I'm chief dad to my sons, Quinn and Evan, and husband to the amazing Tripty. So if you like what we're doing and what you're hearing, please give us a 5 out of 5. This is how we get noted by other organizations. We're getting great credibility with this show, and we'd love to continue that. So thanks, everybody. Today, we will start out with our traditional program. We'll talk about the markets. We'll talk about the general economy and what's going on. And then we'll talk in general about things that we see out there that matter, that we think it's important that people know. So Chris Reardon, you've done the study on the markets. And what does it look like out there right now on the financial markets based on all the different asset classes that we track?
Yep. So international equities is still leading the way. It's still by far in the number one position. It was 248 points. Not much change. It lost 1 point from the last podcast, so it's been relatively stable in that number one position. The next 3 positions, we've had a little bit of a shake-up, actually. Domestic equities bumped up 2 positions, so it was in the 4th position. Now it's in the number 2 position. It gained 22 points from the last podcast, and it's now sitting at 204 tally points in the number 2 position. So big movement there from domestic equities. Commodities moved down from the 2nd position to the 3rd position, and it lost 10 points from the last podcast, and it's at 199 now, so just below that 200 mark. And cash dropped from the 3rd position to the 4th position. It's been relatively stable, so most of the moving has either been done by domestic equities or in commodities is moving towards it. So it's not been cash moving upwards necessarily, but just staying stable. It lost 1 point from the last podcast. It's at 194 in that 4th position. So, and then fixed income is still in the 5th position. It's at 123 and it lost 7 points from the last podcast. And currencies is still in the 6th and last position, minus 3 points from the last podcast at 119. So, the big news I would say is that obviously the movement from domestic equities upwards from the last podcast, and commodities slowly starting to fade a little bit. Moving to the number 3 position.
Yeah. And so, Chris, that's really the big story. Now, the big story with domestic equities moving up is primarily large cap technology, right?
Yeah. I mean, and really, if you drill down, semiconductors have been the top news story. But I mean, Google, Microsoft, a lot of those other tech companies have benefited as well, even Apple. But mostly it's been driven just by AI. A lot of people, the semiconductors had a huge run up with the Bitcoin and mining. A lot of people had to go and buy the graphics cards because that was the most powerful part of the computer. That was the best way to mine Bitcoin when Bitcoin was, 50,000 a coin, things like that. Now people are, I think, predicting that AI is going to do the same thing for semiconductors, that we're going to see this new resurgence, this new boom. I think a lot of people are piling in to hopefully get ahead of everyone. So we've seen the last couple of weeks, really, a lot of movement. NVIDIA came out with great earnings. Last week was up about 30%. So a lot of movement in that tech sector.
Yeah. So that stock was up big too. And that was really an interesting move. It's a massive capitalization stock. It's one of those giant caps. And then when that earnings number came out, it went up 25% in a day. I don't think we've ever seen a massive cap stock go up 25% from that level to another higher level in a day.
Yeah, it was a very, very, very big move. And like you said, Brian, when you factor in essentially it's a mega cap, you factor in the size of the company and that big of a move, I think it shows the breadth and I think also it shows that a lot of people I think are anticipating it to go higher. I think you almost had like a run driving that stock upwards.
Yes. Well, and we talk about large cap, mid cap, small cap, and then giant cap, and I now use the term massive cap companies. There was a time when a small cap company was a half a billion or less, and then a mid cap company was maybe up to 2 billion, and anything north of 2 billion was a large cap. Now you really need to be 100 million or 100 billion to be a large cap, and then 500 billion is a giant cap, and some of these stocks are hitting $1 trillion market values like Apple. And so all the capitalization numbers have changed. So NVIDIA is a massive cap. They're one of the largest companies like Apple and others like that. So, but to see a company of that massive size to go up even more massively is really quite unusual and quite striking. So they really own the AI market now, the artificial intelligence market, Chris, don't they? And in many ways, they've got a premium position in all the areas that they're in.
Yeah, I mean, they're definitely one of the premium graphics card or just semiconductor manufacturers. You have AMD. You do have some other big players in that space. I think NVIDIA gets a little bit of a premium, or at least has as of late. But there's about 2 or 3 players in that space. NVIDIA, I believe, is the biggest. I mean, it's obviously the front runner right now.
Yes. Well, and so we had a huge move in domestic equities, but most of that move came out of the fixed income in the 5th position, and then commodities, which went down to the 3rd position. So commodities have had a big run again, and they were back up to number 1 for a period of time. Now they're fading again, but there's still certain commodities are moving well. Gold hit new highs. Now gold had a big move down, and that could be part of what some of the positions that came out of the gold, the tally scores that came out of commodities in general. But the story really of domestic equities is mostly those technology names. But Chris, isn't the market pretty thin though, even though we're seeing a big move in domestic equity?
Yeah, I mean, I think when people think of the market, I think everyone kind of correlates it to the S&P 500 is the most common. And I think a lot of people don't realize the S&P 500 is really in many ways a momentum index, and it's more weighted towards these mega caps. So the Apples, Amazons, even NVIDIA, Microsoft. So when we have that move in technology, and we saw this going back in 2021, we have a couple names that are really driving the S&P up. When you really look at it, look at the equal weight 500, the S&P equal weight 500, you're getting more and more of a divergence there because it's just a handful of names that are really driving the S&P 500. So, like last week was a great example. I think the S&P 500 was up like 0.32%, where the Russell 1000 value, which is a common index for kind of more value-oriented stocks or dividend-paying stocks, I guess, was down 1.25% roughly. So a big gap there. And that shows that, maybe a few names like NVIDIA last week, AMD, some of these semiconductor names that are, mega caps that are $1 trillion companies are really hijacking, if you will, the S&P 500 and making it seem like it's doing much better when it's only a couple companies.
Well, and Chris, we do a weekly call with our advisors, and we have some guest speakers. A recent guest speaker was Brandon Bischoff at Canterbury, and their commentary and their analysis is that this market is so thin with tech really dominating everything, and then some of the basic indexes are barely up for the year at all. That it's the thinnest market since 1999, the tech rally of 1999. And anybody who was around back then remembers that the NASDAQ was up 80% in that year, yet the average stock in the NASDAQ was down 2%. So that means the giant, massive cap type companies dominated everything. And that's the same thing that's going on right now. So while the technology benchmarks are up in the mid-teens, we've got other indices that are up single digit, and the Dow, I think, is up just 1 or 2%. So it's not up very much. So it's an up year, but it's a rich and a poor type market where if you're in technology, it did well. And if you're not in technology, you're just up a little bit. But, it's, after the big destruction in value of 2022, a lot of investors are still way behind the beginning of 2022. unless, of course, they overly weighted in technology, and they probably would have taken more risk than they should have. It would have worked, luckily, if they did, but it could have gone the other way because technology was down in the mid 40s last year, 40%. So it was really, really bad.
Yep. Yeah. I mean, I think technology really got hit hard last year. I think the kind of upside we've seen to technology this year is a lot of these big tech companies are shedding a lot of employee overhead. They're getting rid of a lot of these extra amenities, trimming down office space. So I think that the market, the investors look at that and say, all right, they're becoming more cost conscious. And with that, they're hoping that it's going to drive more to the bottom line. So I think we're seeing that. Plus, obviously, like we talked about, this kind of AI resurgence that's helping tech. But I think it's important to note, there still it's a volatile market, both up and down now. So doesn't mean that tech's going to run away for the rest of the year. It's certainly working right now, but like I said, there's also, I think, many headwinds and a lot of volatility right now in the market too.
Right. Warren Buffett thinks we're going into a recession. Many other major strategists feel we're going into a recession. All the metrics, the leading indicators that we're seeing now have always pointed to recession. So it's pretty clear we're probably either in one or going into one. Question, of course, is how bad does it get? China is slowing in many areas. We're going to talk more on this broadcast about China, but the consumer discretionary is slowing down a little bit in general because of the slowdown in China, Chris.
Yep. Yeah. I mean, a lot of consumer discretionary stocks, especially the larger stocks that have exposure to the Chinese markets, they've taken a hit. And whether it's not necessarily sales being bad, it's just the presumption that this slowdown is going to maybe not have the effect that I think a lot of people expected. Great example is casino stocks. You have Macau over there. That's a lot of revenue that gets generated. So when you had this reopening story happen, you had a lot of casino stocks that popped 30%. Maybe now they're starting to come back a little bit as maybe the realization that this opening isn't as strong as was originally anticipated.
Yeah, in fact, it's pulling back the opposite way. So we'll cover that in a little bit. A little more on the markets. Morgan Stanley, the big firm, is now seeing its CEO after about 15 years at the helm is leaving. And Morgan Stanley had carved out a position in the industry of focusing on wealth management. They acquired Smith Barney and a number of other firms. So they had a lot of financial advisors and worked on getting strong margins from that business. And Goldman Sachs as well, they made a foray into wealth management, acquiring United Capital. But they've been dismantling United Capital as it didn't pair out to be exactly as they wanted. And Morgan Stanley, however growing they are in wealth management, that's a business we know very well. We manage a wealth management growth operation. The morale isn't great, unfortunately, at the big wirehouses as folks look toward investor choice and advisor choice. So that's a little more limited at firms like Morgan and Goldman. It's more about what the firm wants than what the advisor wants. So while they have done well in the wealth management space margin-wise, they still are seeing people leave at those firms. So it's kind of a temporary short-term gain for them, although Gorman is leaving on a high point for Morgan. But we still see those trends in the wealth management industry where advisors are going in the independent space. Clients are following them. So mini growth story for Morgan Stanley in the short run. The overall story is clients and advisors leaving to the independent channel and the insurance advisor channel. So that's an interesting trend, Chris, although James Gorman gets to leave on a high point.
Yeah. Yeah. I mean, I think you've certainly seen, for those that have been in the investment advisory space, you've seen the flows have mostly moved out of the wirehouses, trend-wise, more to that independent broker dealer even space in general. So, I mean, that's been the trend probably going on, 5 to 10 years now. The wirehouses just aren't what they used to be in many ways. And I think with the dawn of some of the fintech capabilities, you've seen a lot of more flexibility from other firms and capabilities that have been out there. So.
Absolutely. Well, and so that's the wealth management market. Talking a little bit about the real estate market, revenues have slowed down dramatically in real estate brokerage. This time last year, the numbers were astronomical, and we had a extremely strong growth market in real estate up until about May, June of last year, 2022. Then things started to unravel a little bit, and that's gone stronger and stronger as the year has gone on. So a good example is in the major cities, real estate brokerage revenue is down 34% year over year in current months, and then now down 50% for the year. So things are pretty rough in the real estate investment market. Although ironically, we saw prices still heading upwards, Chris, didn't we? A little bit.
Yeah, I mean, obviously, we still have supply and demand going on out there. So, prices continue to remain steady, if not moving upwards. The housing market, I think it's in a really kind of funky place. You're seeing, the volume decline significantly, which is be expected. But with that decline in volume, that supply is constricting so much that and demand is still there, that we're just seeing a stabilization in price, even with interest rates, at 6-7%.
Yeah, it's interesting. So that's really slowing down purchases of properties, but because there's such little inventory, prices are still going up. So the supply and demand curves are still shifting, in tandem the same way. So we're not seeing a huge decline in price in real estate. Maybe in some of the northern cities where they've got high taxes and people are fleeing to more tax-favored, investor-favored states like, Florida, Texas, Arizona, places like that. So we're also seeing a home building boom in America overall. It's not happening really in those major cities we talked about, New York, LA, Chicago, or San Francisco, but it's happening in places like Texas, like Florida, like Arizona, Alabama, and those areas along the coast, the coastal cities in Georgia. So we're seeing big, strong moves in home building. Now, of course, we had a number of hurricanes that took out big swaths of Florida, so we're rebuilding Florida. But with people migrating out of the inefficient states, let's call them, the high tax states, not very business friendly states like Illinois and New York, and moving to business friendly environments, primarily in the South or Tennessee, for example. There's a lot of home building there, so we're seeing a big home building boom as people are replacing their home up north with a home further in the South where they're moving to.
Mm-hmm. Yeah, I mean, I think that with any inefficiencies we're seeing right now in the supply and demand, you have this over demand and under supply. We're going to have companies move to try to fill that and equalize that out. So the issue is home building isn't an overnight process. Obviously, it takes time to build a home and get the permits, all that stuff. So it is happening, and hopefully, the next couple of years we'll see some of that ease up.
So, Chris, turning to the economy, you have a whole list of different metrics we want to share with everybody. So why don't we start that?
Yep. So some of the numbers that came out, the U.S. Producer Price Index, which is, a lot of people think of the CPI, which is the Consumer Price Index, what us as consumers are paying. This is similarly that, but you think about that, but like what the restaurant is paying, it's what the producer itself is paying. So the Producer Price Index increased 2.3% year over year in April, easing from March's year over year number of 2.7%. So we're seeing a little bit of a slowdown in that Producer Price Index. The positive with that, I would say, is usually that tends to be kind of the leading indicator to the CPI. If the kind of restaurants and manufacturers, all that stuff, are paying a little less, if the inflation is hitting them a little less, then usually over time it kind of ebbs and passes on to the consumer. So it's a good sign that maybe we'll continue to see inflation or slow down in the coming months. No guarantee of that, though. On top of that, we saw retail sales rose a seasonally adjusted 0.4% in April after a decline in March. So that's positive. We saw a decline in March. We saw a reverse and a positive number in April. So the consumer got out, spent a little bit more, which is positive. Most of that spending was on dining out, auto. So we're still seeing a lot of travel occurring. We're seeing a lot of, going out, spending at restaurants, kind of splurges, if you will. And I think a lot of that's also, pent up. I mean, if you imagine, we had 2 years dealing with COVID restrictions, things like that. I think there's a pent up want and need to travel, to go out to restaurants, bars, and just relax.
Yeah.
Consumer spending rose 0.8% in April. Up from a 0.1% increase in the February to March. So that was a really positive number. That's a pretty big acceleration. So a month-to-month increase from 0.1% to 0.8% is obviously a big jump there. So, what this points to is, the consumer is still relatively strong. We're seeing consumer spending picking up as we're entering kind of the late spring, early summer months now. So that's overall pretty positive for the economy.
So it's autos and restaurants primarily, and the consumer spending, retail sales, right?
Correct. Yep. Autos and restaurants have been the big drivers of the retail sales. Correct. Moving to kind of what we were talking about before, the sales of previously owned homes fell 3.4% in April from March. So that's the month-over-month number. The year-over-year number for April was a 23.2% decline in sales, or volume, I guess, of the sales of homes from a year earlier. So a big drop there. That's kind of what we were talking about before. That volume has decreased significantly as you have homeowners that are locked in at 2% interest rate mortgages, and don't want to leave. They don't want to subject themselves to a 6% mortgage if they go somewhere else, and it's just not there yet. So that volume is still very low. On the reverse side of that, home prices rose in March for the second straight month. So we had a February rise in home prices and a March rise now. So the S&P CoreLogic Case-Shiller National Home Price Index, which is a fancy way of saying just the average price of the home averaged out across America, climbed 0.4% in March from February. So we continue to see prices, after we had these initial interest rate hikes, we did see the price decline. We did see this start to decline and come back down, as well as volume come down. Now we've seen that kind of stabilize and it's starting to move back up slightly. So it's shown, in my opinion, it's shown a little bit more stabilization than I think was expected with these high interest rates.
So Chris, with the year-over-year unit sales in real estate down 20-something%, but yet the revenue for real estate brokerage is down 34 and 50%. That means they're competing harder, maybe cutting commissions, maybe changing payouts, that kind of thing. It's more competitive. So that's why it's really affecting your real estate brokerages a lot, although it's really a kind of a curious thought that the prices aren't going down. But if this continues, eventually they probably will go down. But in the short run, there's an inventory tightness there that's leaving prices still hanging in there.
Yep. Yeah. I mean, eventually it will. And like we talked about, I mean, this is in many ways a supply and demand issue. So as home builders put more supply on the market, that will help as well. And then who knows where interest rates will be. Obviously, as interest rates come down, that could ease some of this as well, because home sellers will feel more comfortable, being able to list their property, maybe downsize, things like that. They have to take mortgage out after. So,
okay.
Going on. So the return to work, as Brian spoke about a little bit, kind of office real estate has just been getting absolutely pummeled. Most prominently, one of the kind of these office real estate developers, SL Green, which is a stock. It closed at $25.54 last Friday, which was barely above its 1997 IPO price. So you can imagine so many gains just wiped out with this recent, I would say, catastrophe in the office real estate market. And a lot of this comes as, we had this pandemic, we had remote work. And there's certain areas where obviously we've seen more people coming back to the office. But I think in many ways it's been more of a hybrid movement there. And with that, a lot of larger companies may have said, all right, instead of needing 4 floors of office space, maybe we only need 2. So we've seen this kind of pull back slightly for office space. So, it'll be interesting, but it definitely is something that's coming. Whether it affects grade A real estate versus grade B or grade C, that remains to be said. Everything we've seen has said that grade A should fare a little bit better, but we don't really know. And obviously it's going to be heavily dependent as well on the city, the areas. San Francisco, I know, has been the one place that's been hit the hardest because they have heavy tech jobs that can go remote more. And you also had just a huge drive upwards in office real estate prices leading up to the pandemic. So it had the most to fall.
Yeah. Well, and Chris, we mentioned this in a previous podcast about the major office building in San Francisco that sold for $300 million in 2019 is now trading this quarter for less than $60 million. So down 80%. So there's a big move down in commercial real estate because of the pandemic, because of coming back to the office is slow. And some of those trends, I think, over the next 5 years will come back to where they were in 2016, 17, 18 over time. But in the short run, they're going to deal with the fact that they don't have a lot of revenue in these buildings. And so there's a big downturn. If anybody remembers, after the Tax and Economic Recovery Act of 1986, TEFRA, we had a real downturn in the commercial real estate market in the 90s, took almost a decade. And it didn't get healthy until the early 2000s. So it could be that way again in commercial real estate for a while in the major cities. So we'll see. That's a kind of a trend we've seen before, and we'll see how bad it gets. It's obviously in certain areas, San Francisco, very bad, but maybe not as bad in as many other cities. So we'll keep watching that trend, Chris. But every time there's big problems like that, there's also huge opportunities. So we will look for opportunities when there's a big anomaly in a market like that.
Mm-hmm. No, for sure. And then the last thing I'll mention, this just kind of came out of Chevron, obviously the big oil producers buying a smaller company, PDC Energy, for $6.3 billion. And this is, important in many ways. PDC was known for fracking. They had a big foothold in Colorado, Wyoming, and the Permian Basin. So it looks like Chevron is really trying to extend that its reach and build more of its portfolio in those areas. And I think they're trying to take advantage of, the oil market in its current state, which, right now, due to some of the, news out about China being slower than expected, but we've seen stabilization, if not slight pullback in the oil markets. I think they're seeing it as a potential great buy opportunity for 5-10 years from now when we see a full rebound out of that. So yeah, it's interesting to see them kind of double down.
Yeah. Okay. Anything else in the economy, Chris, you want to share?
That's it.
That's about all we got. Okay, well, good. So, so we talked about all these different issues about the economy in the international markets. Also, trends that we see affecting the economy is the immigrant population's increasing. We basically have an open border, although the administration and Mayorkas keep saying the border is closed. I guess officially it is, but they're letting people in, and they're giving them court dates for the future, and many of them won't recover. So the stated policy, even in the campaign for President Biden, was to open the border and let people migrate in. Anyone can speculate as to why that's happening. That's obviously going to hurt employment at some point. It's going to hurt wage growth, but they have some view and some idea of how they want that to be. So we'll leave that to your imagination as to what that might be. But right now, the border seems to be wide open and the number of immigrants is going up. But among the native-born Americans, there's a very tight labor market still. And we're seeing wages hang in there, still a little bit of wage growth, right, Chris? So we'll see if things get tougher in the economy, we'll see that start to crack. We've seen lots of layoffs, and that could also lead to declining wages and that kind of thing. Talked about the office market already. We did talk about interest rates, and interest rates have been on the rise now, and the Fed has gone through 10 interest rate increases, anywhere from 75 basis points to as little as 25 basis points. So we moved up to a 5% level. And so, of course, as we came into the last interest rate increase, all the predictions were that that would be the last one. It would be what they call the terminal rate, meaning the high rate. And then usually once they reach a terminal rate, the average is 4.5 months later, then the Federal Reserve will start easing and lowering rates again to get the economy going again, because increasing interest rates slows things down. The Fed needed to slow things down because inflation was out of control. So we saw inflation as high as 9% right now. It's still about in the sixes. So it's staying persistently high. So why everyone thought that the Fed would not raise interest rates anymore was kind of perspective. I'm not sure why they thought that, because as I sat here thinking inflation's still high, after 10 interest rate increases, this is a perfect setup for another interest rate increase. And even though the markets were betting that it wouldn't, 84% of observers said that rates were as high as they're going to go. Sure enough, St. Louis Fed President James Bullard came out a few days ago and says, I see at least one or maybe two more rate increases. And so that changed the whole perspective. So a month ago, there was an 84% belief that interest rates have stopped rising. And now there's a 60+% chance that interest rates will go up again. So it's all changed. What we thought a month ago was going to happen is now all different. But anyway, so that's where we are with interest rates. We'll probably see some small interest rate increases and certainly not decreases for a while until the Fed actually sees inflation waning down to at least the 3% level. And that may be a number of months before we get there, or even later this year. So I think it's going to be a while before that happens. Anyway, so that's, I think, what we have in the economy. Chris, with the general, what we see out there, let's talk international, let's talk China. You have some comments there as well.
Yeah, I mean, we got some interesting news out of China last a couple of weeks ago. We got news that the China's joblessness rate for people aged 16 to 24 rose to a record 20.4% in April, which is pretty astounding when you think about it. That's a very large portion of that population. And we're talking millions upon millions of people. And the problem that we've seen out of this is because China isn't creating enough high-wage, high-skill jobs. We have this younger generation in China that is getting skills, that maybe to work in a office or work, in a different job skill set, and there's just not enough of those jobs for them to, work at. So, that's been a serious issue, and the fact that if this persists, it's going to be a big hamper on the Chinese economy overall.
Yes.
So that's been a big issue. And then China's factory activity came out, and it contracted for the second straight month. It fell to 48.8 in May, and that's from 49.2 in April. So anything below 50 is contraction. So not only is it still in contraction, it even moved even further into contraction with this latest May reading. So, two statistics that we've seen kind of come out there, two of the numbers we've seen come out of China so far have really pointed to a pretty dull opening, what was anticipated to be a strong opening, I should say, from China. So it's had a big impact. It was definitely one of the reasons we've seen commodities pull back slightly. China tends to be a big consumer. And if the Chinese economy is going to sputter more, if we're going to not see this big kind of explosion, maybe we're not going to see the Chinese consumer spending as much. We're going to see that impact commodities. We're going to see that impact companies, like we talked about consumer discretionary, especially. So we're definitely seeing that ripple effect throughout the global economy and commodities, and also U.S.-based companies. I know, like I said, gaming, Las Vegas Sands, some of those stocks. Wynn was got a big presence in Macau, got hit hard pretty last week. So we're just seeing this kind of readjusting with a lot of these companies to, the certain realization now that the Chinese reopening isn't as strong as was originally anticipated.
Yes, and they're not creating enough jobs, as you said, and they've got a misallocation of resources in China. We're going to cover a little bit more later why we think that is. But then they also banned some companies too, didn't they, Chris?
Yep. So they also came out and banned Micron Technology, which is a semiconductor company. A lot of this has been seen as retaliation for some of the U.S. restrictions on Beijing companies. Hawaii or HTC is a great example. TikTok, which has been in the news, I believe one of the states just banned it from.
Montana.
Montana banned it. So, I think this is seen as retaliation. So interesting out of there. And we'll see if that continues to escalate, this kind of friction between the U.S. and China. Then kind of pivoting now to the European markets, Germany's Q1 GDP numbers came in at negative 0.3%. And that officially puts Germany in a recession. Just for refresher, they came in at a negative 0.5% Q4 2022 number. So 2 quarters of negative growth is the technical term of a recession. So, that puts Germany in a recession. And, that puts a pretty big damper on the European Union as a whole. Germany tends to be kind of the heart of the European Union. They're the big manufacturers. So the fact that they're in recession does not bode well for some of the other countries there. And then the last thing I'll mention is we did see on the positive front, a Greek stock surged last week after a very unexpectedly easy victory for the ruling Conservative Party. So kind of a nice plus or positive there that we saw out of Greece.
Well, interestingly enough, Chris, we're seeing some changes in governments in Europe. Europe has long been known as a former economic stronghold that became too bureaucratic, too full of regulations and everything else, and so Europe has been a kind of weak economically relative to the United States for a number of decades now, and now we're seeing people unhappy with that in Europe, and now they're throwing out the liberal governments and then electing more conservative governments that are going to be tougher on getting the economy going and those kinds of issues. So we saw that in Greece. So this is the second now election for the conservatives in Greece, and they're trying to turn things around there. We saw that happen in Italy. We saw that happen in Denmark. So while it seems like the United States is going more progressive, or at least there's people who are pushing hard to get there. Certainly the current president is, the other countries of Europe are going back the other way. So now there was a backlash where the conservatives took the House of Representatives in America, but it was expected to be a lot stronger than that. So we really haven't seen a conservative movement in America, such like there has been in Europe. So we'll see how that all develops if the public has had enough of Biden economics and the economy that we're in right now, and if in the fall those elections turn conservative like they did in Europe. So we'll see.
Yep. Yeah. I mean, it's definitely been, there's definitely been a struggle, if you will, and it seems to be in Europe. We're seeing more conservatives. We've even seen it kind of in Germany, things like that. So, it'll be interesting. I mean, just like anything, when you have a big dose of, let's say, maybe more liberal ideology for a while, tends to kind of get too saturated. And sometimes we have that retaliation or that move back towards maybe more conservatism, more towards the middle.
Well, in a change, Prime Minister Erdogan was reelected in Turkey. That's significant because a big crowd of folks in Turkey were wanting change. He's been in office now over 20 years. And so there was a big crowd of folks, Turks, that were looking for big change. It was a narrow victory, but Erdogan won again. And he's become the strong man of Europe, essentially, very powerful, from a more weaker government to a much more stronger government over the last decade. And so we'll see what those trends look like over time. So anyway, I guess that's enough on international. We'll come back to China. Chris, I was going to say, Elon Musk might take Starlink public now. That's another big thing we're seeing that could release pressure on Tesla, because Elon Musk was selling shares of Tesla, which ran it way down to $100 a share from $400 a share. Big move down. I think at one point in the year in 2022, it was down 75% from the high, and it ended down 69% for the year. And a lot of that was selling stock for Twitter and SpaceX. Now, if he brings that other company public, there may not be as much pressure on Tesla stock going forward because he'll have other capital from Starlink and he'll be able to fund things a different way. So that's an interesting trend. And let me comment also on India. Prime Minister Modi has, I say, done it again. Folks might remember in 2017, Prime Minister Modi tried to clean up corruption in India and turn India into a well-heeled, well-operating capitalistic environment, decided in a very quick move over 6 weeks to remove the $500 or 500 and 1,000 rupee bills from circulation. The reason was, of course, is those were the two largest bills in circulation, and there was rumored to be significant stores of printed cash in hidden places that were achieved at that level because of corruption. And so by forcing everyone to turn in their 500 rupee, 1,000 rupee bills, then they were forcing people to declare where they got all that money. So if you have a modest life and you have a small apartment and all of a sudden you show up with 10 million rupee, they might ask you where you got that. And that's exactly what was going on. So then we saw shuttling back and forth across the border of Pakistan with people moving rupee bills across the border and getting gold the other way and selling the gold. And there were people that died in the desert in 2017 and all these things. My wife and I actually were in India the last week of December 2017 when all this was going on, watched people standing in line at banks with piles and piles of rupee bills trying to get their rupee bills handed in. So this all was historical. So Modi did it. And then at that time, they created the 2,000 rupee bill. It was a new bill. So now Prime Minister Modi has announced that they're going to get rid of the 2,000 rupee bill because they believe a number of corrupt players have stepped back into the market. So they're going to try and clean house again. So as I say, President Modi has done it again, or Prime Minister Modi. They also say that might be political because there's an election coming up. So he's looking to gain the favor of the public that doesn't like the corruption and of the ruling elites in India. So that could be part of it. So the interesting story is that because of the foibles of China with their one-child policy and their population decreasing, India is now the largest country in the world with over 1 billion people. And China lost 800 million, so they say, people, but in 800,000 people. In reality, we think it's significantly more than that. We don't usually trust many of the numbers coming out of China. If there are things that are bad, they'll say it's less bad. Things that are good, they'll say it's better than that. So we see numbers like that all the time. Either way, the official numbers say India is much larger now than China and growing, where China is actually contracting. So we'll see what that develops. There is a writer's strike going on in America. The writers want higher wages and restrictions on artificial intelligence. Now, artificial intelligence, which is the same thing, Chris, that moved that stock of NVIDIA and some of the other semiconductor chips companies, that is clearly a trend that it's a genie they may not be able to put back in the bottle. So artificial intelligence and then ChatGPT and all the other aspects of that are something that's out there, and it's probably not going to change. So the writers are nervous, and they want restrictions put on AI. And so we'll see who wins that, right? There's fear that if you want a certain article written, you can just tell your ChatGPT to do it, and artificial intelligence will figure all that out and write the article for you. You won't need a writer. And so that's another interesting trend. And everybody remembers the buggy whip ended up leaving when the gas-powered car came. So there are things that change technologically in an economy. So if they don't need as many writers, those writers will end up doing something else, apparently. And that's the way the dynamic destruction system works in capitalism. But right now, the writers are fighting, aren't they?
Yep. Yeah, I mean, I think it's if anyone ever wants to, you sign up for a free Chat GPT account. You can type in there, write me a letter, saying, to the president of the United States, saying that you want higher wages or something, and it will actually write it. So I mean, some of this is already in existence now, kind of what it can pull and what it will pull from different resources of the internet. So it certainly is a threat, and it's certainly something that is very real and very, here right now, I should say. Obviously, it still needs a little bit of work, but it's pretty much at our doorstep, on that front.
Yeah. Well, and then the other trend we're seeing, obviously, is America's shrinking cities. New York, Chicago, San Francisco, Los Angeles, all showing weakness in population due to high taxes, high regulations, lockdown policies, and all the other things that went with the pandemic. And those trends are going to more competitive states, lower tax states. It just happens to be that they're mostly, but not all, in the South. We're seeing some movement to Colorado, maybe Idaho, Montana, and other states like that. South Dakota, where there's low taxes and high competition states where you can actually grow a business and that kind of thing, where it's harder and harder in those shrinking cities and the states that go along with it. So that's an interesting trend. We'll see if that changes. And then I wanted to get back to China, Chris, and talk a little bit about that. President Biden has said that we will see a thaw in the China relations after we saw that big balloon issue that came across America. They finally shot the balloon down long after it had gone well across our whole nation and taken military secrets across military bases and everything else. Ironically, former Defense Secretary Bob Gates says President Biden has been wrong on pretty much every major policy decision in the last 40 years. So they think that he'll be wrong on this issue too, that China is not going to thaw. Many think that the reason Biden is saying that is they believe he's compromised. Congressman James Jordan and James Comer are involved in investigations, and they have uncovered what looks to be massive evidence that there are problems with President Biden, and he is perhaps compromised by China. So we'll see how that plays out. But ironically, the minute Biden says that we will see a thaw, then we had a massive cyber attacks coming from China targeted toward none other than Microsoft. So I don't think China's backing away, Chris, anytime. I don't see any thaw happening. Do you?
No. I mean, I think that, China's trying to reassert itself or assert itself, I should say, on the as a major player in the, global relations. And I think that's playing out even in with the Russia-Ukraine invasion. Obviously, Russia's been a big player. It's actually brought them closer to ties with Russia, closer ties to even India. So, there's been a little bit of a void there, I think, with tensions between the EU, between the US, and obviously Russia, and China certainly kind of stepping into the void. And that's in direct conflict with, what the US wants.
Yes. Well, and China's been trying to infiltrate the U.S. for many, many years. They've now uncovered police stations in the United States. There was one closed with big fanfare in New York City, but there's still 6 police stations they know of that have not been shut down, where the Chinese government is in our country trying to police its own people and gain certain advantage. Also, China is experiencing at home a plunging economy. China's real estate market is plunging. Steel prices are contracting. The worsening debt defaults in China. There were many people that had signed up for a new property, but they never got that property delivered because that city never got populated. So they're now fighting back. There's 300,000 people that own properties that they'll never buy. The Chinese government's going to have to deal with that. That was announced a number of months ago. And there's food shortages. So there's a lot of things happening in China that are really an offshoot of the uncompetitive, government controlled, communist controlled government. And those governments don't allocate resources efficiently. So it's they don't understand what people's desires are. When all individual actors make their own decisions, that's how the market allocates resources, and it allocates resources through pricing mechanisms. So prices go up, people buy less, prices go down, people buy more, markets find equilibrium. They don't do that really in China. They make things through diktat. They tell people what they have to do. So that leads to inallocation of resources. The supply demand curves don't work quite right. And so we're always going to see that. So it's always inefficient. Capitalistic markets are the most efficient way to do that. There's certain abuses in capitalism, obviously, and that's why certain laws are meant to minimize those abuses, like antitrust acts and things like that. But for the most part, capitalism has created significantly more wealth over a period of time. And certainly in America, it's the American story. So going to war and taking over other countries and meddling other countries is what they really need to do. There's talk now that Japan, as a diversion from their own woes, might be considering going into Japan or in the Philippines, or Taiwan, of course, has been talked about, or even starting against the U.S. In Guam in the South Pacific. So economies that don't grow look to take over others. They don't grow internally. They need to grow by acquisition. And in a government sense, that means starting wars or starting acquisitions. Think Russia, think China. Russia keeps taking over other countries or trying to. China's doing the same way. It's because their economies don't operate well in their own. By doing so they extend their influence, they capture more tax base, more resources. It's just fundamentally different way of running a country, but they have to grow to survive. And the way they grow is taking over other countries. Countries like America don't need to take over our countries because we're growing internally. We have the right tax policy, we have the right incentives, and everybody works for all the good. So anyway, all this points to economic growth as the answer. America is an economic growth society. 4-star, we're economic growth people as well. So I just wanted to point that out. That could be why all this is happening with China. And Gordon Chang, author, thinks that China will eventually collapse over the next decade. So we'll see if that's true. We know they've got many massive problems, including a population decline and aging a society. One-child policy has not worked, and they're America's greatest competitor for sure. So anything else, Chris, on your end?
No, I think that's it.
All right. Well, we got a couple of things here before we end it. The Leadership Matrix blog, which is on the 4-star website, 4starwealth.com. If you scroll down to the blogs of what our advisors are saying, in our program, we have a piece about spending and how spending is all in your head. You may create a budget, but many investors, then they don't have their budget in front of them when they're spending money. So then you have to come up with certain heuristics or certain ways in how you feel comfortable spending. And there's an examination of how people do that sometimes spending habits have no relation to the budget that they just made. So we have to kind of figure out a way to get those spending habits in line. And there was an interesting study by University of Chicago. It's in an article that's in our blog. And those who want to get on our mailing list are able to by just going on to 4starwealth.com, the Leadership Matrix, entering your email, and we'll continue add you into the blog, or call us and we'll add your email in. We also had another piece, probably the final piece, about the visit that I personally had with Captain James Lovell of Apollo 13. He was the captain of Apollo 13, which was a failed mission, and they were expected to die out there in space and not make it back to America. I was part of a contingent from the Boy Scouts of America and the National Eagle Scout Association to present Captain James Lovell with the Distinguished Eagle Award. He's in his mid-90s, living in a senior home in Lake Forest, Illinois. We met his wife, Marilyn. When he was on the far side of the moon, they were one of the only moon missions to go to the far side of the moon. He named a mountain after his wife, Mount Marilyn. If you look that up on the website, you'll see Mount Marilyn. We met Marilyn. She was in a wheelchair in her mid-90s. She was there with her husband, Captain Jim Lovell. He's been a very avid Eagle Scout. Most of the astronauts on the NASA program have been Eagle Scouts. Most, not all. I think about 80% of them. So we got to meet Captain James Lovell. It was a great experience. And we played music from Pink Floyd about the dark side of the moon, right? So anyway, that's all on our website as well. And then also we have a podcast interview with Dominic Vaccaro and Jack Cassidy of Burlington Capital. We talk a lot about investing in stocks and bonds and other financial assets, but we also do a lot of work in alternative investing. And the Burlington Capital folks are folks that offer programs in multifamily housing. We have a broad list of different multifamily programs. They're an interesting group out of Omaha, Burlington Capital. So we wanted to interview them and talk a little bit about that space. And if anybody's interested in investing in alternative investments, you can talk to myself or Chris or your financial advisor at 4-star, and we'll be happy to talk to you about more ways you can invest in those areas. But enjoy the visit with the Burlington Capital guys. They're very interesting characters and might be worth your while. So, Chris, why don't we leave it there?
Sounds good.
All right. Well, thanks everybody for the 4-star advisors. And now we're growing. We're crossing the billion asset mark here this quarter. We have 33 advisors in 14 states and a staff of 12 people across the country. So for our whole great 4-star team, for Chris Reardon and all the other folks who are involved with the 4-star operation, we want to thank you. We will be back with another episode very shortly of Today's Market Explained. And we'll leave it there, folks. Let's have a great day, and we'll see you at the next episode. Thank you.